Can creative financing really double your business without any additional marketing cost? Stay tuned to find out. That is the question that we're digging into in this three-part series. So welcome back to NoteSchool TV. My name is Brian. I'm on the teaching team here at NoteSchool. If this is your first time watching NoteSchool TV, man, welcome and thanks for jumping on board. I'd like to encourage you just to like this video. If there's value you're getting out of it, like the video, subscribe to the channel, and probably more importantly, specifically for this show, is to click that bell notification so that you're getting the notifications coming in. So when we go live, you know that you can jump on and participate. Type into the chat box, add your comments on the platform that you're on, and actually engage with us while you're here. If you're brand new and you're just like, I'm just still trying to figure this out, what is NoteSchool? What are notes? What are you guys talking about? And you just want to know what that next step is outside of this video, go to noteschool.com/TV to learn a little bit more about notes and who we are at NoteSchool and kind of what we talk about. We've got some pretty exciting stuff coming up as we are live, like we are every single Wednesday at 11 a.m. Central Time. And so I'm going to bring on, before we get too far down this, I want to go straight to the news with Joe Varnador. You there, Joe?
All right, so we have the news today, guys. So a couple of news flashes here. So the first one is, you see the screen there? This is from the M report, and 40% fewer homes for sale since last year. So U.S. homes for sale dipped below 700,000 for the first time ever in listed inventory. So nationally, the number of homes was down. Actually, it's 39.6% year over year, with 449,000 fewer homes for sale compared to December of 2019. Realtor.com also reported the median listing price grew 13.4% year over year to $340,000. And $340,000, and homes sold in 66 days on average last month, 13 days faster than in 2019. The second flash here is that in the 2-week period ending January 1st, we haven't gotten all of December's numbers in at this point, but mortgage applications decreased by 4.2%. According to the Mortgage Bankers Association. And guys, those results were adjusted for the holidays, right? So secondly, in addition, the holiday adjusted refinance index decreased 6% from 2 weeks ago and 34% lower than actually 2 weeks ago as well. 30-year, we talk about these penalty box buyers, and we're going to talk about that with our guest here today in just a minute. So the average interest rate on a 30-year fixed was $510,000 which is $510,400 or less, decreased to 2.86 from 2.90, with points increasing to 0.35 from 0.31. And guys, here's the big kicker. Loan to value ratio was 80% on these loans. In order to get that 2.86 rate, your debt to income ratio or your loan to value ratio had to be 80% or less. And then one quick flash that I didn't have a chance to make a screenshot on here for you guys today. If you live in New York, right? If you live in New York State, the foreclosure moratorium has been extended. Now, nationally, it's been extended to the end of February. If you live in New York, it's now been extended to May 31st, 2021. Guys, I can tell you that takes into effect the rental payments as well. So landlords are hurting, guys. So we talk about the burnout landlord capital. The heat is on, baby. All right, that is the news today, guys. It is some crazy, exciting things going on out there in the world.
Man, I love it, Joe. So next up, we've got our founder and friend. Let's bring on Mr. Eddie Speed, and I'll let you guys take it away.
Well, hello, guys. How are you?
I am doing great, Eddie. How are you, man?
I'm good. I am charging through January. I had a town hall meeting with our staff last week, and Joe, you were on there, of course.
Yes, I was.
But I had a town hall meeting with all of our companies, NoteSchool and our colonial companies, the people that are in the note buying space and trading space and all that. And I said that I'm more excited about what I see ahead of us in 2021 that I've ever seen literally in my 40 years of doing this in the past. I told that to my internal team, so you can pretty much understand that there's crazy stuff in the news, Joe. Entrepreneurs make money when we know how to solve problems in a market that nobody else solves. And our guest today is a problem solver. And we were able to help him add a big problem-solving dimension to his business. But he's a good problem-solving thinker, and I really enjoy this guy. And it's just a big deal of how he's added this to his business. It's a big deal to him. Obviously, we appreciate him sharing with you guys and us some of his successes. So, Joe, bring Dan on, and let's crack this code.
Hey, let's bring on Dan. Dan, this is Dan Walters. Dan is one of our students from Boise, Idaho. And Dan, you and I talked about this the other day. It is it's an interesting market in Idaho, is it not?
It sure is. Yeah.
One of those highest growth areas in the U.S., dude. Who would have thought it?
Yeah, who would have thought? This is our little secret here for a little bit, but that secret's been out for a while now. And I mean, and Eddie, as you can probably attest, and being in Texas, all the influx coming in from some Western states are Texas and Idaho seem to be the destinations to go. So it's been a wild ride and continues to be. So
that's what they call Austin, Texas, is little California, and I think that's what they call Boise, Idaho, now, right?
Yep, exactly.
So,
it is.
Just a quick background. So Dan and I have some mutual friends, and I participated in a mastermind that Dan is in. I've done some training for them on a number of occasions for the last few years. This is one of these high volume real estate investor masterminds. And Dan has done coaching, so he's helped other people do the business, and he's a very active investor himself. So it's what I want you guys to hear today is you can start this whether you have a significant background in real estate or you don't have a significant background in real estate. What Dan would tell you is what we're teaching is like, it's not like all these high volume guys have this figured out, do they, Dan?
No, not at all. No, actually, there's a very small percentage that are just starting to figure it out.
So we talk about the idea of somebody coming in like a NoteSchool trained person and helping these high volume guys because there's such a shortage of people that know how to do it. So, Dan, we're going to throw up a case study today of an asset that you bought. You told us the other day you have 4 terms deals working right now.
Yeah. So it was for as hot as the market's been, it's been a little challenging to step in with some sellers that want to sell for a full retail price, but they know they can get it pretty quick. So when we're bringing terms to the table, it's just it is like it's a long play. It's a conversation we've got to continue to have, and 2020 was not ideal for that. However, we were always continuing to present that and study it, and then I think it's just been the activity and the opportunities to continue to offer that, and all of a sudden it's just kind of hit it. So it's just been the activity behind it.
Well, here's how I say it. If you can buy property and get the seller to carry terms for you in the hottest real estate market in the country, it shows you the power of it works when things are good, and it works for things, obviously, for a market to come that may not be so good. Yeah. And we're not calling all markets the same, and we're not saying everything's going to have the exact same effect. But we do know that that terms are why I originally started this idea a couple of years ago. It was a way to disguise the price, because you're buying it on discounted terms and not a discounted price. So, Joe, pull your PowerPoint up. If
we are ready to go, man. It is we are ready and got the case study up here and ready to go, man.
Dan, can you see that?
I can. Yep.
All right. So just kind of go down through it with us, if you will.
Yeah, just real quick background on this. This seller had actually owned this property for 30 plus years. He's kind of right in the middle of a super highly growth area, a high growing area, fast growing area. He's on an acre of land here, so it's just a really highly desired piece of property. But he had a set amount in mind that he wanted. He had multiple conversations over the last year or 2 years with people coming in and with developers wanting to come in and develop it. But he knew he had a set price in mind that he needed to get to make his transition, pay off some debts, all that kind of stuff. And the developers weren't even coming close to what he needed. So he was just been sitting on it. So
Dan, let me ask you, so the current market value is the 515, and let's show the before and after. There's the before on top and the after on the bottom.
Correct.
Beautiful place. And Dan, this thing is
extensive rehab on this, right, Dan?
What's that?
You did an extensive rehab on this.
Yeah, it was 30 years of deferred maintenance and a lot of DIY stuff. So it's
yeah. So Dan, so the as-is value on this is kind of amazing. I'm gonna kind of run through these 3 points here, and then I'll kick it back to you. But you said the as-is value is 310,
and that's prior to at the time.
That was the as-is. Your cash offer, Dan, was 245, which was it too low for? It must have been too low for the seller, right?
Correct.
Okay. So Dan, this is the crazy part. So you come in and your cash offer was 1, and your terms offer is $325,000, which is a little bit over the as-is value, as you reported.
Yep, just a tad bit, because that's exactly what the seller needed.
Right.
Yep.
So that's the crazy thing, guys. There's two unbelievable things about this set of numbers up there. The as-is value was 310. Dan structured a deal where he could offer more than the as-is value. And it had a big rehab budget in it. I mean, it is a big rehab budget. So, and by the way, that of the 90,000 in rehab, though, you didn't put 90,000 up, did you, Dan?
No, it did not. No, I actually had part of that was funded by our private money that came in and helped us finance that.
Let's talk about that. So Dan, you went out. So your total in this, by the way, you've got 3.25 in the terms offer, then you've got a $90,000. So that's 415, right? So you structured the deal like this. You got a private first, like you said, from one of your private lenders for $281,000.
Yep.
And the terms on that, they were not so creative, right? I mean, you got a 6.4% loan from a private investor for 30 years at 1756 P&I.
Correct.
Okay.
Joe, let me make a point about that, though. When Dan does that, that's a loan that can be paid off. So if he finds another private investor, private lender that wants to loan him money at 5%, he can move that 6.4% money out and 5% money in on the same deal.
There you go.
Yep.
Yeah.
Now, Dan, here's where you get creative, right?
Yeah.
You've got a seller second for 90. And talk about each of these terms here that we're flashing up on the screen here, kind of as they pop up. So, no payments for the first 12 months, right?
Yeah. So here's the thing. I mean, you had a seller who has been really wanting to sell for the last couple of years, but he knew he had a number. He was set on the number of where he wanted to sell it, and he had talked to many people who couldn't come to that. And so when we finally started having this conversation, there was a sense of joy in this seller's eyes, and the hope that finally somebody's going to come through for us. And I think once he was able to realize that we could obtain this for him, because he was retiring and moving out of state, he was willing to, he was happy to accommodate in some of these other terms, because finally there was somebody that could solve his problem. So yeah, he was willing. Like I said, he needed a certain amount of money to pay off some debts, and then it also would help him transition to this new acquisition, to his new home he was going to out of state. So he told me what that number exactly was, and so that associated our down payment, and then he was willing to carry the difference on that. And that tickled him to death. So we knew that we were going to have some extensive rehab. So I just let him know that, hey, look, we're going to be in some time with this thing. So if you can give us a little bit of cushion here before our payments start, I wonder if you can give us, at least a year to be able to kind of get this house where we need it to be. And then we can turn around and it makes money for us. And then also at the same time, it makes money for you.
So Eddie, you and Dan talked just a minute about this crazy thing that's step rate. What's a step rate, guys?
Well, this is a concept that the more of these deals we cut up, we started figuring this out, that people would agree to an extraordinarily low rate or no rate to start the loan, and down the road, then to get them to carry it, they wanted more interest. But the smart thing that Dan did here is, by carrying at such a low rate, he is accelerating the principal payoff of the loan, right, Dan?
Yeah.
It's a lot. So all of a sudden people think, well, 4% interest isn't a bargain, but for 5 years, really 6 years, because the first year was nothing. For 5 years, he is sawing off the additional principal at an accelerated rate, which means he's paying 4% interest, but 4% interest on what? Less principal.
Right.
Less money. So the math is really good. Another clever thing that, Dan, you now do just as an automatic is you set up annual payments, right?
Yeah. And that was something that through the education and just being a part of on some of these calls with you guys, realizing that, hey, we give these annual payments and really separate the note carrier, the seller, from their payments over a period of time. They realize that, hey, that money isn't coming in every single month like clockwork. It's just one lump sum. And as we know, most people don't, when they get their money, the majority of people, they burn it pretty quick. And so they're always looking for more money later. So that's
your play down the road is you're pretty sure he'll call you wanting to sell that, wanting a payoff of his note at less than the full principal amount owed. You'll buy your own note at a discount.
Yeah, and that's what we're anticipating. I mean, he's on a fixed income, so we know that at some point in time that phone call is going to come.
Yeah.
So, guys, now we've bought it. We've papered up our buy. Let's talk about, Dan, how you sold this to a penalty box buyer. And guys, remember, a penalty box buyer is just somebody that's missed, right? They've got a good down payment. They're strong. Maybe they're self-employed. Maybe they're a gig worker, whatever it looks like. They're just missed, and they're really part of that 35% of folks that could get a loan back in January of last year that starting in March of last year, they just couldn't. So let's talk about the sale, right? So you've got a total of $415 in this thing, right? So you sell it for $515.
Correct.
Strong down payment, $45,000.
Yep.
Okay. So we've got a $45,000 down payment. We've got a $470,000 wrap lien on the loan. So we got $470 at 5.75. And you're doing this for 30 years, 360 months. So you've created yourself some cash now, and we'll talk about that a little bit more in a second. And then you've got a monthly payment of $27.42 coming into your little bank, right? Your Dan's National Bank for the next 30 years.
Correct.
I just have to laugh. I mean, that's some crazy numbers, right?
It is crazy. And the thing of it is when, with being on enough of these case studies and these calls and just watching all, call after call, case study after case study, and it's going, okay, I know this works, but the question is, is there going to be somebody out there that's going to have that amount down? Is there going to be somebody that's going to be able to make that monthly payment, that's going to be able to truly qualify for it? And the fact of the matter is, once we started advertising it, I mean, they come out like the woodwork. And there's what we found. There's plenty, like you said, the penalty box buyer. There's plenty of people that do have that cash in reserves. They're business owners. They just don't fit in the box that the traditional lending criteria just don't allow. And it was amazing to see the amount of people that really came out and and really just solidified everything. I mean, because it wasn't so much for me, it was more of the higher price point, because we were kind of pushing the limits here, I think, a little bit on this particular one. I mean, we felt comfortable at like a 200, $150, $250, $300,000, but to get up to that 515, it was kind of questioned, like, how's that going to work? But man, it was.
And I was going to make a point about that. People tell me, well, seller financing works on little cheap houses, right?
Right.
125,000 or less, and it works in San Antonio and out in the country, but nobody would buy a $500,000 house with seller financing. But here's the reality, Dan. Let's look at where the market is, and if a home buyer today, if there was 1,000 people that could qualify for a conventional mortgage last February, 1,000 people, today there's 650 of those people that can qualify, and 350 of them that no longer can get a mortgage.
That's right.
Right. So there's a big market gap. No, we agree real estate's on fire. There's a shortage of listings, but there is also a shortage of financing. Just people aren't talking about it as much.
Yeah. And the other thing that we're seeing too is we have there's a lot more people that are starting businesses. I mean, especially with the things that have gone on this year, people have, they've had an opportunity to step off into do their own thing on the side. And so they've realized that, hey, they're having success, and then maybe they're able to step away from the job in the last year and a half, 2 years. Or 3 years, whatever it is, and their financials aren't super strong, or they're not a W-2 employee. So banks just kind of go, no, sorry, but they've got solid tax returns, they've got great reserves, they've got great P&Ls, and their credit's solid. It's a no-brainer.
Yeah. Yeah.
All right, guys. Well, let's talk
exciting to see it. Go ahead, Joe. Let's look at the cash flow here.
Let's look at the cash flow. So here's the total income on this thing, guys.
So after you sold it, you ended up with $45,000 profit in your pocket, right, Dan?
Correct.
And then this thing, after you pay, you have 2 mortgages you have to pay every year, right?
Right.
You have the private first and the seller second.
Correct.
And then you're receiving a bigger payment. So you have a wrap mortgage. You're receiving a payment with an obligation of making 2 payments.
Correct.
But you're netting like $8,300 a year, $8,200 a year. I'm sorry, $8,200 a year net income after you pay those mortgages.
Yes. Yeah.
For a long time.
Yeah, that's awesome.
Yeah, the National Bank of Dan is doing well. And guys, I mean, that's almost a mic drop, right? So you took something that, you could have flipped it and made a little money, but again.
And yeah, and just to drive this point home, I have a rental portfolio as well. That's net income that we're talking about right here. That's not gross income. So on my rentals, I see the gross income come in, and I got to take about 45% out for taxes, insurance, maintenance, for all that kind of stuff. When this comes in, it's just straight bottom line.
And guys, I want to point one other thing out to you real quick here, that we've got a link on there for the Moneyball book, right? So that is the Eddie's book. It's called Moneyball 2: Creative Real Estate Financing: The Cure for Thriving during post COVID-19. So there's a link there. This specifically is what we're talking about today, is in chapters 3 and 4 of that book. So make sure that you download that when you get a minute and read it. And we're going to finish up the book next week on next week's episode, by the way.
Yeah, there's a lot of different strategies, and people think that seller financing always has to be the seller has to carry all of his equity. And in this case, the seller walked away with a lot of cash, because Dan, you went and found a private lender.
Yep.
That loaned you the money. That essentially that money went partly for the rehab and mainly to the seller, right?
Yep.
And then all of a sudden you were in a good position with him, because he didn't have to wait for all of his money. He had to just wait for part of his money.
Right.
And I believe, particularly in really competitive markets, I think this is a seriously underused strategy. And that's why I wrote about it in that book, is I'm like, guys, this is a deal that in other words, the house needed $90,000 in repairs. What was he going to do when he called a realtor, right?
Yeah.
The realtor couldn't solve the problem.
Right. Yep. Absolutely.
So, all right. So Dan, I just want to know, I want to kind of unwind this right here at the end. What do you know now that you did not know a year and a half ago?
Well, let's see. Well, biggest thing, stepping into NoteSchool, it opened up the possibilities of where the traditional cash offer model from a wholesaling standpoint and everything else is, if we can't get it, 65 or 70%, whatever it is, then it's just not a deal. Here, every lead that comes in is a potential opportunity. Because in the traditional wholesale business model, it's maybe 1 in 20, 1 in 30 leads turn into a deal. Here, every lead that comes in is a potential for, if it's not for the cash offer if it's not the cash offer realm, there's all of those can have a potential to fall under the terms realm. So there's excitement when a lead comes in because every single one of those could be a possibility to convert.
That's absolutely right. Your field of vision, it goes from this to this.
Yeah,
exactly. Dan, you're awesome, dude.
Stick around. We're going to have an after party for a few minutes after, so hang in there with us, and Brian's going to take us out here today.
Appreciate you guys. Thank you.
Yep.
Yeah, thanks, guys. Thanks, Dan. Man, this was a perfect example of someone closing way more deals, creating very profitable notes that are going to pay them for a very long time. And speaking of notes, this wouldn't be complete if we didn't mention our sponsors, Notes Direct and Feeding Frenzy Friday. That's right. Each week we have a playlist called Feeding Frenzy Friday where we take a note off of Notes Direct and we break it down to help you really better understand what are some attributes of a note that I should be looking at to qualify it or disqualify it, what lowers my risk, what increases my returns, all those kind of things. And this week was a very interesting one. We actually are breaking down a note from New York. You heard Joe talk about the moratoriums being expanded to the end of May in the state of New York. And what's interesting about the note this week is, first of all, there is a 15-year track record already. They've lived in the house since 2005. And so who do you think is going to pay? A renter who's lived there for a couple of days, maybe months, right? Or somebody who has 15 years of, history there and a track record of paying. And so that's one piece. And the other piece is this, that the payment's around $500 something, right? Whereas the rents in that area are $950. And so with all this craziness that's going on with the moratoriums, this person is very incentivized to make this payment, because if they don't, they have to come up with $950 to leave that house and go rent somewhere else, if that makes sense. So check out those videos. As always, we'd love for you to just like these videos, like the Feeding Frenzy videos as well. Definitely subscribe to the channel so you can check out all the playlists, and make sure you're clicking that notification so that you can engage with us here, as well as stick around for the after party that we're going to go into. Make sure you get your questions answered and stuff like that. I mentioned at the beginning, if you're brand new and you're just trying to figure out what is that next step, what is NoteSchool, how do I get involved, go to noteschool.com/TV to learn a little bit more. Next week, join us on Wednesday at 11 a.m. Central. We're going to go through part 3 of this really unique creative financing story and kind of dig into it a little bit deeper. As always, thank you for your time. Thanks for joining us. Stick around for the after party. Otherwise, we will see you on the other side.